My question is, I have no formal education in accounting and finance, and I would just like some advice from you regarding an approach to educate myself in a reading list of basic texts, obviously starting with the Berkshire Hathaway Annual Reports. Thank you.
And the question you ask is a very good one about, in terms of accounting and finance, what's the best way to teach yourself? I was always so interested in it from such a young age that my approach was to go to the Omaha Public Library and just take out every book there was on the subject. And I learned a lot. I learned a lot that wasn't true in the process too. I got very interested in charting and all that sort of thing and buying stocks. But I did it by just a tremendous amount of reading. But it was easy for me because it was like going to baseball games or something of the sort. And in terms of naming specific texts in accounting, and I think you may want to read some of the better even magazine articles that have appeared. I mean, there've been or newspaper articles. There've been some good commentary about accounting there. I don't have. Can you think, Charlie, of any specific texts or anything that we could recommend?
I think both of us learn more from the great business magazines than we do anywhere else. It's such an easy shorthand way of getting a vast variety of business experience, just to riffle through issue after issue, covering a great variety of businesses. And if you get the mental habit of relating what you're reading to the basic structure of the underlying ideas being demonstrated, you gradually accumulate some wisdom about investing. I don't think you can get to be a really good investor over a broad range without doing a massive amount of reading. I don't think there's any one book that will do it for you.
Yeah. You might think about picking out 5 or 10 companies where you feel quite familiar with their products, maybe, but not necessarily so familiar with their financials and all of that. But pick out something so at least you understand if you understand their products, you know what's going on in the business itself, and then get lots of annual reports and through the internet or something else, get all the magazine articles that have been written on those companies for 5 or 10 years. Just sort of immerse yourself as if you were either going to work for the company or they'd hired you as the CEO or you were going to buy the whole business. I mean, you can look at it in any of those ways. And when you get all through, ask yourself, what do I not know that I need to know? And back many years ago, I would go around and I would talk to competitors always. You'd talk to employees of the company and ask those kind of questions. That's in effect what I did with my friend Lorimer Davidson when I first met him at GEICO, except I started from ground zero. But I just kept asking him questions. And that's what it really is. One of the questions I would ask if I were interested in the ABC company, I would go to the XYZ company and try and learn a lot about it. Now, there's spin on what you get, but you learn to discern it. Essentially, you're being a reporter. I mean, it's very much like journalism. And if you ask enough questions, Andy Grove has in his book, he talks about the silver bullet. You talk to the competitor and you say, if you had a silver bullet and you could only put it through the head of one of your competitors, which one would it be and why? Well, you'll learn a lot if you ask questions like that over time. And you ask somebody in the XYZ industry and you say, if you're going to go away for 10 years and you had to put all of your money into one of your competitors, the stock of one of your competitors, not your own, which one would it be and why? Just keep asking and asking and asking. And you'll have to discount the answers you get in certain ways, but you will be getting things poured into your head that then you can use to reformulate and do your own thinking about why you evaluate this business at this or that. The accounting, you just sort of have to labor your way through that. You may be able to take some courses even in that. But the biggest thing is to find out how businesses operate.
I would like to know the accounting book you like best. Thank you.
Well, it's been a long time since I've read an accounting book. I read Finney back when I was in college. I remember that. And I always liked accounting. And for any of you interested in business, you basically can't get enough accounting. But I don't, I am not really up to date on accounting books. Maybe Charlie's been reading some of those lately. I would hope, actually, that if you read the Berkshire reports over time, that you get certain, perhaps, lessons on accounting. But I think you learn more accounting probably in terms of, well, I mean, once you know the basics of it, by reading good business articles that deal with accounting issues, accounting scandals, that sort of thing. I mean, that's what you really need to know. Is you need to know how the figures are put together, the underlying principles of it, and then you have to know what can be done with those. And you start with the accounting figures as the raw material of understanding a business, but you have to bring something additional to that. And I can't think of any good books on that subject. I think I've read a lot of good magazine articles that contributed to my knowledge over the years. And I've read a lot of annual reports and seen what people can do with accounting. And as I've said before, if I don't understand it, I figure it's probably because the management doesn't want me to understand it. And if the management doesn't want me to understand it, there's probably something wrong going on. I mean, people don't obfuscate with numbers, usually without a purpose. And when you run into that, the best thing to do is just stay away. Charlie?
Yeah, asking Warren, what good books he knows about accounting would be, it's like asking him what good books does he have about breathing. And what the implication of that is that you start by learning the basic rules of bookkeeping, which are sort of like the basic rules of addition and subtraction. And then you have to spend a lot of time before that accounting gets related to the larger reality. And that's a lifelong process.
Pay a lot of attention to what we regard as the reality of the balance sheets and economic condition and cash situation, all of that of a business. And sometimes we think accounting reflects reality and sometimes we don't. It's a good starting point for us always. But I mean, there are companies in the there's at least one company, at least last year, that was using a 12% investment return assumption on its pension plan. And there are other companies that use, I think, even below 6, certainly 6. And in the end, should we look at the figures the same of one company, particularly if the pension fund's a big element, that uses 12 and 6? No, we look at what it says they're using, but in our minds, we don't think the company that's using a 12% assumption is likely to do any better with their pension fund than the ones that's using 6. In fact, we might even think the one that's using 6 is likely to do better because we might think they're more realistic about the world. So we start with the figures of the companies we look at, but we've got our own model in mind as to what they will look like. It's true of the businesses we own 100% of. Some of them have some debt in them, some of them don't. Partly that situation's inherited. In the end, we've got the same metrics that apply to them, whether they happen to have some debt on their own particular balance sheet or not, because in the end, we're not going to be willing to have very much debt at all at Berkshire. And where it's placed doesn't really make any difference because we're going to pay everything we owe no matter where it is. And it's almost an accident whether Company A or Company B has a little debt attached to it.
I have a two-part question. First part, very short. I think a lot of people have difficulty valuing businesses because of some convoluted accounting schemes that are out there. Do you have any suggestions in terms of books or something you can read where you can sort of make sense of some of the accounting stories that are going around?
Well, that's a good question. And Abe Breloff used to write for Barron's quite frequently on various accounting machinations, and Barron's has continued that somewhat. But you're right that there are people out there who will try to paint pictures with accounting that are something far from economic reality. And sometimes the rules of accounting themselves lead to that. I would say that when the accounting confuses you, I would just tend to forget about it as a company. I mean, it's probably, it may well be intentional, and in any event, you don't want to go near it. We have never had any great investment results from companies whose accounting we regarded as suspect. I can't think of a one. Can you try?
No.
It's a very bad sign.
I made a short sale once that worked out well in a case like that.
Oh. It really, accounting can be accounting can offer you a lot of insight into the character of management. And I would say there's a lot, you run into a fair amount of bad accounting. I used to call it creative accounting, but and you probably run into a lot more if it was allowed. But some companies have been able to push their auditors pretty far, and I would be very skeptical of anything that looks suspicious to you. I think there have been a couple of things written, but I can't think of where they've appeared, where people talk about the questions of what. Obviously, if some prepaid expense, deferred asset accounts start building up suspiciously high, and inventories look out of line, with sales and particularly the trend of them and all that, you want to look twice at companies like that. Life insurance, frequently, we see weak accounting in it. You can, when you don't have a product where revenues and expenses are being matched up on something close to cash in the short term, you have the opportunity for people playing games with numbers. And some people have learned how to do that very well, and they've sometimes created long-lasting stock manipulation or promotion schemes that have enriched themselves where they've enriched the managers or the creators of it at the expense of the public over time. If you ever get suspicious about accounting, just go on to the next company.
You have been recently quoted in the newspapers as saying that some major corporations have used questionable practices to make their operations seem more favorable. Would you be willing to be more specific about these practices?
Not until I'm on my deathbed. I have followed a policy of criticizing by practice and praising by name, and we will not, we do, Charlie and I both find certain practices very, very deplorable, and they aren't limited to a single or a few large corporations. But we would probably be less effective in arguing for change if we went to a few specific examples. They would not be that much different probably than hundreds of other, or at least dozens of other companies. And secondly, those who get critical of the world find the world gets very critical of them promptly. And I think we do more good by, in a sense, hating the sin and loving the sinner. So we will continue to point out the sin, but we will not name the sinners. Charlie?
Warren, I think she wants you to name the practices,
not
the miscreants.
No. Well, the practices are some of the things we've said. They relate to accounting charges that are designed to throw into a given period a whole lot of things that should have been covered in subsequent periods in the earnings account, or to smooth out or to inflate earnings in future accounts. There's a lot of that being done. There's a lot of it that's been done. The SEC under Arthur Levitt, who I admire enormously for his efforts on this, is making a concerted attempt to get corporate America to clean up its act on that. But it'll only be because somebody hits them over the head. I mean, it has become totally fashionable to play games with the timing of expenses and revenues, and frankly, until the SEC got tougher, in my view, the auditors were not doing enough about it. I think that in terms of hiding compensation expense and not recording it in the case of options and all of that, I think companies now have the option of recording option costs in the income account. But you have not seen any great flood of people doing it. And actually, the way they show it in the footnotes is quite deceptive in my view, because they try to make assumptions that minimize what the income account impact would be. But the cost to the shareholder is what counts. I mean, that is the compensation cost as far as we're concerned, and that's been minimized. The whole effort to engage in pooling rather than purchase accounting has seen a lot of there's been a lot of deceptive accounting in that respect. There's been deceptive accounting on purchase accounting adjustments. So those are the kind of things we're talking about. Charlie?
Yeah, it's the big bath accounting and the subsequent release back into earnings of taking an overly large bath that create a lot of the abuse.
We could name names, we won't. But I mean, we have seen firsthand managements who think they are doing, they say they're doing what everybody else does. The truth is they are now, because everybody else is doing it. And it takes some outside force, in this case probably the SEC, it should have been the auditors, to clean up the act. Because once it becomes prevalent, the fellow who says I'm going to do it fair and square, all of a sudden becomes at a disadvantage in capital markets. He's penalized, and he says, why should I penalize my shareholders by doing something when legally I can get away with doing something else?
Earlier in the meeting, you said when reading over financial statements, you identified companies you were virtually certain were frauds. What was it in those financial statements that you saw that made you be so certain they were frauds?
Well, it varies just enormously over the years, but there are, we can't identify 100% of the frauds or 90% or 80%, but there's certain ones that jump out to you. Just people give themselves away a lot too. I mean, in poker they talk about tells, and Charlie and I have bought a lot of businesses, and it's very important when we buy those businesses that we assess the individuals that we're buying from with some degree of accuracy, because they hand us the stock certificate and we hand them a lot of money, and then we count on them to run the business with as much enthusiasm after they have the money as they did before. And so we are assessing people, and we don't think we can assess everyone accurately. We just have to be right about the ones where we make an affirmative decision. And those decisions have not always been perfect, but they've been pretty good, and I would say they probably have gotten a little bit better even as the years has passed. Similarly, in looking at financial statements, for example, in the insurance field, we've seen some frauds, and you can see things being done with loss reserves occasionally. We saw it back in, I won't name any names, unlike Charlie. We'll call them company A's and B's instead of naming names. But you would see companies that when they were offering stock to the public, the year or two before that, the reserves would go down very suspiciously, and or even when they were selling them to other insurance companies. If they were buying in stock, they might be building the reserves. But there's a million different ways, and I don't claim I know all the ways, obviously, but I have seen enough situations over the years, and I've seen how promoters act, and you can spot certain people who are one way or another playing games with the numbers. They give themselves away, but I can't give you a checklist of 40 items or something of the sort that you look for in the balance sheet or the income account or the footnotes. Charlie, can you help him anymore?
Sometimes it's pretty obvious. I once was introduced by Warren, of all people, by accident, to a man who wanted to sell us a fire insurance company. And Among the first things he said with a thick accent from Eastern Europe, I think.
Don't name countries.
And I don't remember the country.
Good.
But what he told me was, he says, it's like taking candy from babies, he said. We only write fire insurance on concrete structures that are underwater. And I figured out instantly that it was probably fraudulent.
The guy's a crook.
I'm a very acute man.
Yeah, the guy's a crook. Yeah, well, you had some experience, as a lawyer in the movie industry in a few places.
Oh my God.
Yeah, when you get into accounting for, well, movies are a good thing. I mean, in terms of how fast you write off properties and anything where you've got construction in progress or progress payment type things. There's so many ways you can cheat in accounting. In financial institutions are particularly probably prone to it. And there's been plenty of it in insurance.
A lot of it, they're not being deliberately fraudulent because they're deluded. In other words, they believe what they're saying.
Yeah, people like to hire them as salesmen. If you've got doubts, forget it. Basically, there's probably some reason. It's interesting. The accounting, they've worked harder and harder and harder at coming up with disclosures in accounting, and I'm not sure I find present financial statements more useful, or in some cases as useful as I found them 30 or 40 years ago. I don't know. Charlie, you have it?
Well, I think the financial statements of big banks are way harder to understand now than they used to be. They just do so many different things, and they've got so many footnotes, and there's so much gobbledygook that they're not my grandfather's banks.
Yeah. Well, we couldn't understand them when we owned them. I mean, we bought a company that generally where they had 23,000 derivative contracts. And Charlie and I could have spent 24 hours a day and had the help of 10 or 20 math PhDs, and we still wouldn't have known what was going on. And it cost us about $400 million to find out. And that was in a benign market. But nobody can.
And the accountants had certified the balance sheet.
Sure.
It's a new kind of asset I invented a name for. I said, good until reached for.
Yeah. Well, and you would actually, the same auditing firm would be auditing two different companies that are on the opposite side of a derivative transaction and attesting to different values to the same contract. Charlie found one mistake at Solomon on a derivative contract. What was it, 20 million?
No, it was a big contract, and both sides reported a large profit blessed by their accountants on the same contract.
Kind of like us in
just
Swiss
for
Re.
making it. Once people get in a competitive frenzy, things just go out of control.
I became the interim chairman of interim CEO of Solomon in 1991, and fortunately I had testified to both a House and Senate committee before I found this out. And generally speaking, incidentally, Solomon wanted to have conservative accounting. I think that would be a fair statement, and in many cases did. But they did come into me one day and they said, Warren, you probably should know that we have this item, and I think it was around 180 million or something like that, with a capital base of 4 billion maybe, but 180 million. And they said, this is a plug number, and we've been plugging it ever since Fibro merged with Solomon in 1981 for 10 years. This number moved around every day. And as I remember, Fibro, or one of them was on a trade date system, and that was on a settlement date system. And in 10 years with Arthur Andersen as their accountant paying a lot of money in auditing fees, they just never figured out how the hell to get the thing to balance. So they just stuck a number in every day. And they literally plugged it for 10 years, and I couldn't figure out how to unplug it myself. I mean, you almost had to start over. Didn't they do that one time out there?
We did that.
Yeah,
yeah,
right.
We had a discrepancy when we changed accounting systems in our savings and loan, and none of the accountants could fix it. So we just let it run out.
Yeah, we let the account.
We just let the account run out,
and we start over again.
We started over, right?
Accounting is not quite the science that people might want.
In accounting, you can do things like they do in Italy when they have trouble with the mail. You know, it piles up and irritates the postal employees. They just throw away a few carloads, and then everything flows smoothly thereafter.
Folks. That happened in some unnamed international country.
Yeah, Italy.
I have a follow-up question to your comments about how financial statements can be distorted by making over-optimistic assumptions about returns for the pension portfolio. If you believe accounting statements, as published in annual reports, returns on equity for U.S. businesses are amazingly high, higher than in Europe, higher than they've been historically, higher than Japan. Are these highs, do you think, completely attributable to accounting shenanigans, or are there any fundamental reasons in addition that might make returns in the U.S. higher than in Europe or higher than they've been historically?
Well, I would say that they certainly, to the extent that American returns have been higher than those around the world, at least in developed countries, I would say that they are not solely due at all to accounting shenanigans. I think that the absence of honest accounting for option costs has been a factor, but American business has done very well, excluding any accounting activities that Charlie and I might differ with. I'm no expert on exactly what returns have been around the world in developed countries, but my impression definitely is that American business is well above average for the developed world in terms of profitability, and I don't have the answers as to why that's occurred. I think that American business and I think the whole American system has reflected more of a meritocracy than exists in many countries, and I think that a meritocracy works best. I think that mobility between classes, which is the flip side of a meritocracy, does tend to get the Jack Welches into positions of where they run a General Electric or an Andy Grove or an Intel, or go up with Sam Walton at Walmart. I think if you'd taken those same individuals and dropped them down in most countries, they would have done very well, but I don't think they would have done quite as well as here. And I think that what they have done well has spilled over in a big way to benefit the American economy. So I would not lay it all on the accounting shenanigans. And the pension fund accounting, that applies very heavily at some companies, and of course most newer companies don't have pensions. Companies that have started in the last 20 or 30 years are much more inclined to have various kinds of profit sharing or 401ks. The older industries that took on pensions, spurred to a great degree, I think, by World War II, when you got excess profits taxes that ran to 90%, and there was a huge incentive to start pension plans and fund them heavily, because the government, in effect, was funding 90% of your pension obligation. So there was a great boom period in the inauguration of pension funds, and of course that meant steel and auto and all of those big industries of that time. Charlie?
Yeah, it isn't so much accounting shenanigans as it is deliberate financial practice. Take General Electric. There's been a deliberate increase in financial leverage, which was made possible by the wonderful and deserved reputation. There's been a deliberate increase in repurchase of stock, which General Electric has done even when they're paying huge multiples of book value. That sort of thing does wonders for returns on equity, as reported, as does the process of writing off everything in sight and various extraordinary charges, removing the burden of past costs from future earnings. You put all those things together, and American returns on equity are higher partly because the management is deliberately set out to paint the company as unusually efficient in its use of capital, meaning that it earns a high return on shareholders' equity. Think of how high we could drive our return on equity at Berkshire. I mean, we could make it almost any number you want if we just used enough leverage.
Yeah, we could run it with no equity.
We could run Berkshire with no equity. Yeah. And then people could say, gosh, these guys have finally learned how to manage the damn thing. It's not been an objective around here to reduce the equity to zero. But at other places, in order to make the reported return on equity good, they deliberately pound down the net worth as much as they can.
Yeah, the questioner may have seen, if you look at the S&P figures of the last 15 years, they report them both before special charges and after special charges, and there's been a very significant difference between those two figures. I mean, the American business likes to frequently write off things and say that doesn't count. And of course that takes the equity down, and it actually frequently benefits future earnings because you remove costs that would otherwise hit the income statement in future years.
The truth of the matter is you have part of this is shrewd and correct management of the company's financial structure and operations. And part of it can drift into gamesmanship.
We don't like complicated accounting. I mean, we really do like things that produce cash, and Enron is a good example. Enron's grotesque in what happened, but there's no question in my mind that auditors have been unduly compliant to client wishes over the last few decades, and more so as they went along, even to the point where they started suggesting what I would consider quite dubious accounting to people in mergers and so on, so as to make their figures look better later on. And I've seen it firsthand. So I think that although the auditors are supposed to work for the shareholders, that they got too much so they were working for management. But I think that Enron may push them back significantly, even in the other direction. So I think Enron will have a distinct beneficial effect on auditing, and it was needed.
Well, it's going to have a distinct beneficial effect on one fewer auditors.
Yeah, although, you know, it's an interesting question, and Charlie and I may differ on this. I mean, I don't know how many people Andersen employed, but it was a huge number. And it's clear that the weaknesses and culpability at Andersen goes far beyond anything remotely we saw at Solomon. But it would have been a shame for Solomon, with 8,000 people, to have actually the bad acts of one guy and the lapse in terms of reporting and all of that, which was a big mistake, but by a few other people, caused 8,000 people to get dislocated in their lives and lose their jobs. I don't know, how do you feel, Charlie, about, you know, the bottom 40,000 people at Andersen who really didn't have a damn thing to do with shredding or the Houston office or anything of the sort? I mean, their lives are really getting changed in many cases.
I regard it as very unfair and totally undeserved in all those cases. Yet even so, I think that capitalism without failure, somebody once said it's like religion without sin, or
religion without hell.
Religion without hell. I think when it gets this bad and the lack of adequate control mechanism throughout the system, I mean, Andersen plainly didn't have a good total system of control. And I think that it may be that capitalism should just accept this kind of unfairness in all these individual cases and let the firms go down.
Well, let's say you and I did something really terrible, Charlie, at Berkshire. How do you feel about the other 130,000 people then? I mean, should they?
You'd feel terrible about them. And there's no question about it. And but I'll tell you something, they wouldn't go down. The way we're organized, they wouldn't go down. Warren, there's nothing you can do that is going to destroy the value of the subsidiaries and the careers within the subsidiaries. You can blow your own reputation. You can blow the reputation at the holding company level, but you can't destroy their livelihood. That is a good way to be organized.
We could mess up their lives, though. I mean, if they lost their funding, or I mean, I agree with you about their viability, but you know.
Andersen was particularly vulnerable, being a professional partnership. But maybe you should be extraordinarily careful if you're a professional partnership with what clients you take on and how far you go for them. The law firms that I admire most have fairly strict cultures of risk control. I think it's crazy in the kind of world we inhabit to operate in any other way.
The second involves the role of creative accounting and the stories of tremendous growth and success over many years. GE, Tyco, and IBM immediately come to mind for me.
He asked about creative accounting, and he named certain companies. I wouldn't agree that all those companies were plainly sinful, although I'm sure there are very significant sins in the group as a whole. Creative accounting is an absolute curse to a civilization. You can argue that one of the great inventions of man was double entry bookkeeping, where we could keep our economic affairs under better control. And it was a North Italian development spread by a monk. And anything that sort of undoes the monk's work by turning this great system into kind of a tool for fraud and folly, I think does enormous damage to the country. Now, I think a democracy is ordinarily set up, so it takes a big scandal to cause much reform. And there may be some favorable fallout from Enron, because that was certainly the most disgusting example of a business culture gone wrong than any of us has seen in a long time. And what was particularly interesting was it took in eventually a lot of nice people that you wouldn't have expected to sink into the whirlpool. And I think we'll always get Enron type behavior, but it may be moderated some in the next few years.
I was hoping you could also discuss that issue in relation to Coke. Some people have said that their decision to lay off much of the capital in the system onto the bottlers who earn low returns on capital is a form of creative accounting. On the flip side, others counter that Coke's valuation at first glance on, say, a price-to-book metric is actually less richly valued than it seems because they earn basically all the economic rents in the entire system.
The question of accounting and the economic profits to be gathered in the bottling system versus the production of the syrup at Coke. I've just gotten through reading the annual reports of Coca-Cola, FEMSA, and Panamco, which are two big Latin American bottlers. And I mean, they make pretty decent money, quite significant money, and there is more money in owning the trademark. It isn't the plants that make the syrup or anything else. The trademark is where a huge amount of value is. The trademark is where a huge amount of value is in See's candy. Those are big assets. And I would say that you can make good money as a bottler. A lot of bottlers have become rich over the years. If I had a choice between owning the trademark and owning a bottling business, I'd rather own the trademark. But that doesn't mean the bottling business is a bad business at all. And it's riding on the back of a trademark. I mean, that is why a bottling system is valuable, is because it has the right to sell a trademark product, which hundreds of millions of people every day are going to go in and ask for by name. And the right to distribute that product is worth good money. And I don't see any accounting questions in that sort of thing. In other words, if the Coca-Cola company did not own a share in any of its bottlers, and for many years it either owned 100% of a bottler or large part, and very few of those or none of it. But if they own no interest in their bottlers, I think the economics would be very, very similar to what they are now. I mean, the bottlers would still be able to borrow a lot of money because they would have contracts with the Coca-Cola company and that were important and that would allow them to make decent money distributing the product, but they don't make the kind of money that you make if you own the trademark. Just the way it works.
Yeah, that accounting issue is of a type that is very common within Berkshire. We are so horrified by the terrible business decisions we see made all around us by people who are relying on over-optimistic accounting that we tend to almost reach for opportunities to make our accounting very conservative, way more than other people. We think it protects our business decision-making as well as our financial integrity. I don't know why we ever got into this business of trying to get the accounting result as close to the chalk as we could possibly get it. What is wrong with the world when everything is a little bit underreported? I mean,
yeah, generally people think that reporting, and transparency and all that has improved over the years. I felt much better working with the financial statements in 1960 than I feel working with financial statements in 2000. And frankly, in many ways, I thought they taught me more about what the company was really about than the current ones do, even though there was far less detail. And what we really deplore is solving operating problems by accounting maneuvers. And, Gen Re had some problems in the mid-'80s when everybody did, and they went to discounting their workers' comp reserves. And it was a quick fix, but it's like heroin. And you get on it, and it's not easy to get off. And Charlie and I have seen that time and time again. People that think, trade loading, whatever it may have been, they think they're going to solve something by playing accounting games. And they're encouraged by their CFOs sometimes, and frequently they were encouraged by their big name auditors in one way or another to really play with the numbers. And it catches up with you. You might as well face reality immediately and take whatever operating steps are necessary to solve problems, or if you can't solve them, just give up on them. But whatever you do, playing with the numbers it never works. Although I guess if you're 64 and a half and you're going to retire at 65, it might get kind of tempting.
Mr. Buffett, in this year's shareholder letter, you have harsh words for the new accounting rule that requires companies to use market value accounting for their investment holdings. For analytical purposes, you said, Berkshire's bottom line will be useless. I'd like to argue with you about that. Shouldn't a company's earnings report say everything that happened to and within a company during an accounting period? Shouldn't the income statement be like an objectively written newspaper informing shareholders of what happened under the management for that period, showing what management did to increase shareholder value and how outside forces may have affected the firm? If securities increased in value, surely the company and the shareholders are better off. And surely they're worse off if securities decreased in value. Those changes are most certainly real, In my opinion, ignoring changes in the way that some companies ignore restructuring costs is censoring the shareholders' newspaper. So my question is, how would you answer what I say?
Well, my answer to the question asked what my answer would be to what he said. I would ask Jack, if we've got $170 billion of partly owned companies which we intend to own for decades and which we expect to become worth more money over time, and where we reflect the market value in our balance sheet, does it make sense to every quarter mark those up and down through the income account when at the same time we own businesses that have become worth far more money in most cases and become, you know, since we bought, you name the company, just take Geico, an extreme case. We bought half the company for $50 million roughly. Do we want to be marking that up every quarter to the value and having it run through the income account? That becomes an appraisal process. There's nothing wrong with doing that in terms of evaluation, but in terms of a value, and you can call it gain in net asset value or loss in net asset value. That's what a closed-end investment fund or an open-end investment fund would do. But to run that through an income account, if I looked at our 60 or 70 businesses or whatever number there might be, and every quarter we marked those to market, we would have obviously a great many, in certain cases where over time we'd have them at 10 times what we paid. But how quarter by quarter we should mark those up and run it through the income account, where 99% of investors probably look at net income as being meaningful in terms of what has been produced from operations during the year, I think would be, well, I can say it would be enormously deceptive. I mean, in the first quarter of this year, you saw the figures earlier where we had the best, what I would call operating earnings in our history, and our securities were down $6 billion or whatever it was. To keep running that through the income account every day, you would say that we might have made on Friday, we probably made $2.5 billion. Well, if you have investors and commentators and analysts and everybody else working off those net income numbers and trying to project earnings for quarters and earnings for future years to the penny, I think you're doing a great disservice by running those through the income account. I think it's fine to have marketable securities on the balance sheet, the information available to their market value, but we have businesses there. If we never would do it, but if we were to sell half, we'll say, of the BNSF Railroad, we would receive more than we carry for, and we could turn it into a marketable security, and it would look like we made a ton of money overnight. Or if we were to praise it every 3 months and write it up and down, it could lead to all kinds of manipulation, but B, it would just lead to any investor being totally confused. I don't want to receive data in that manner, and therefore I don't want to send it out in that manner. Charlie?
Well, to me it's obvious that the change in valuation should be noted, and it is and always has been, goes right into the net worth figures. So the questioner doesn't understand his own profession. I'm not supposed to talk that way, but it slips out once in a while.
Sometimes he even gives it a push.
Pertaining to cash flow analysis, given the practices of the numerous corporations of deliberately fabricating cash flow numbers, which occurred in some of the telcos where they characterize like-kind exchanges as product sales, how do you ferret out this type of fraud? What do you recommend a shareholder, an individual investor to do, short of obtaining a degree in forensic accounting, to uncover this type of fraud?
Yeah, I think you're asking for a lot if you want some simple way of not being taken in by the frauds of the world. If you stop to think about it, enormously talented people deliberately go into fraud, drift gradually into it because the culture carries them there. And the frauds get very sophisticated and they're very slickly done. I think it's part of the business of getting wisdom in life that you avoid getting taken by the frauds. And so I think you're asking a very good question, but I don't think there is any short answer. I think there are whole fields that you can just quit claim because it looks like there's too much fraud in it. And I think we do a lot of that, don't we, Warren?
Yeah. How many times have we been defrauded in the last 20 years, huh?
Well, damn little that we can. It's amazing how little.
Yeah.
And I've always said that the guy who takes us is going to have a modest little office and modest demeanor, and
he'll carry around Ben Franklin's autobiography, I can guarantee it.
The kind of people who defraud us are not going to be the kind of people who are defrauding everybody else.
Yeah, I mean, it's a very good question. It's tough to answer, but I will tell you that we haven't and we won't get defrauded often. Now, that may mean we pass up a whole lot of other opportunities too. But for example, you raised the question about cash flow. I would say the number of times we're going to buy into a company, whether it's through stocks or through the entire company, where people are talking about EBITDA is going to be about zero. I mean, we start out with, if somebody's talking about EBITDA, you know, if we take all the people in the world who have talked about EBITDA and all the people in the world who haven't talked about EBITDA, there are more frauds in the first group, percentage-wise, by a substantial margin, very substantial. I mean, it is a, you know, it's just a start. Now, that isn't, you know, that it's very interesting to me. If you look at some enormously successful companies, Walmart, General Electric, Microsoft, you know, I don't think that term has ever appeared in their annual reports. I mean, they just, so when people are talking about that sort of thing, either they're trying to con you in some way or they con themselves to a great degree. I mean,
or both.
Yeah. Well, that often happens. I mean, if you set out to con somebody, after a while you con yourself, which is why some of the people in the internet stocks, you know, stayed with them. It's, if somebody is, if they think you're focusing on EBITDA, they may arrange things so that that number looks bigger than it really is. It's bigger than it really is anyway. I mean, the implication of that number is that it has great meaning. You take telecoms, they're spending every dime that comes in. I mean, in many cases, and it isn't cash flow. I mean, the cash is flowing out, but it, you know, you can look at the statement and there's billions of dollars supposedly in depreciation and so on, but they're, you know, interest is an expense. Actually, taxes are going to be an expense. Anybody that tells you that making a lot of money before taxes, that in terms of EBITDA is meaningful, you know, you get depreciation by laying out money ahead of time. It's the worst kind of expense. We look for float, where we get the money and then pay out later on. But depreciation occurs because you buy an asset first and then you get the deduction later on. It's the worst kind of expense there is. And you start paying taxes when you actually make money and when the depreciation runs out at some point. So it just amazes me how widespread the usage of EBITDA has become, and I would say there have been people who have tried to dress up financial statements in a way to appeal to people who were impressed by such a number. Charlie and I have found actually that, at least to us, many of the crooks look like crooks. I mean, we have spotted, we haven't shorted them, but we have spotted a lot of frauds over the years in public companies, and years before, you know, that the roof fell in. And they usually are people that tell you things that are too good to be true, for one thing. I mean, they you know, they tell you very mediocre businesses are wonderful businesses for one reason or another, or they just have a smell about them, you know, and in effect.
You have argued against the use of alternate measures of profitability, such as earnings before interest, tax, depreciation, and amortization. as measures of business performance. At the same time, you have frequently cited the incompleteness of generally accepted accounting in reflecting economic reality for some businesses, implying that there are some necessary and proper adjustments. Beyond what you recently described in the annual report as the folly of omitting depreciation, could you elaborate on your thoughts on other pitfalls of alternative financial presentations? Is EBITDA, in your view, just too often used as a shorthand for cash flow, or is the entire concept of recasting accounting data a suspect exercise? And which revisions might be appropriate, if any, and what might be viewed as red flags? And does it matter to you who is making those adjustments, analysts, investors for their own purposes, or company managements in terms of how that information should be viewed?
Yeah, we regularly told you for some years before the accounting change was made here a year or so ago, we told you you should not count goodwill amortization. You know, it was required under GAAP, and we obviously complied with GAAP, but we told you every year virtually that I can remember, we said this is not really an economic expense. And we ignore it in our own calculations of earnings in terms of what we will pay for businesses. We don't care whether there's a goodwill item or not because it's immaterial to economic reality. So we have been quite willing at Berkshire to tell our own owners to ignore certain things, and if they disagreed with us, they could look at the GAAP figures, but we felt they were getting misled by looking at the amortization of intangibles. That doesn't mean we think all intangibles were good, but we did feel that was an arbitrary and a decision that didn't make any sense at all. And we've felt, obviously, as we've talked about, we've felt that crazy pension assumptions have caused people to record phantom earnings in many cases. So we're willing to tell you when we think there is data that is more important in economic analysis than GAAP figures. We'll talk to you about it. Not thinking of depreciation as an expense, though, strikes us as absolutely crazy. I can think of very few businesses. I can think of a couple, but I think of very few businesses where depreciation is not a real expense. Even at our gas pipelines, I mean, you know, at some point they'll need repairs, but beyond at some point they become obsolete. I mean, there won't be gas there 200 years from now. We know that. So depreciation is real, and it's the worst kind of expense. It's reverse float. You know, you lay out the money before you get revenue, and you are out cash with nothing coming in. And depreciation, any management that doesn't regard depreciation as expense is living in a dream world. But of course, they're encouraged to do that, by investment bankers who talk to them about EBITDA, and then certain people have built fortunes on misleading investors by convincing them that EBITDA was a big deal. And when we see companies that say, we don't pay any taxes, and because we don't have any earnings for tax purposes, and don't count depreciation and all of that, that's coming, in our view, many times that's coming very close to a flim-flam game. I get these people that show me, they want to send me books with EBITDA in it, and I just tell them, I'll look at that figure when you tell me you'll make all the capital expenditures. If I'm going to make the capital expenditures, there's very few businesses where I think I can spend a whole lot less than depreciation year after year and maintain the economic strength of the business. So I think the EBITDA has been a term that has cost a lot of investors a lot of money. You saw it in the telecom field. I mean, the idea that they were spending money so damn fast, they couldn't have it coming in the door fast enough from investors. And then they pretended that depreciation was not a real expense. That's nonsense. I mean, it couldn't be worse. And a generation of investors were sort of brought up to believe in that. We at Berkshire will spend more than our depreciation this year. We spent more than our depreciation last year. We spent more than our depreciation the year before that. Depreciation is a real expense. just as much as, the expenditure for lights. It's not a non-cash expense. It's a cash expense. You just spend it first. The cash is gone, and it's a delayed recording of cash expense. And how anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
I knew he'd do it sooner or later, folks. And he made it through the morning, but never all day.
First question, in your letters to shareholders, you said you believe EBITDA is not a good parameter to value a business. Why is that? Can you elaborate on that?
In respect to EBITDA, depreciation is an expense, and it's the worst kind of an expense. We love to talk about float, and float is where we get the money first and we have the expense later. Depreciation is where you spend the money first, and then record the expense later. And it's reverse float, and it's not a good thing. And to have that enter into a multiple, it's much better to buy a business that has, everything else being equal, has no depreciation, because it has essentially no investment in fixed assets and makes X, than it is to buy a company that where there's a lot of depreciation in getting to X. And I may write a little bit more on that next year, just because it's such a mass delusion. And of course, it's in the interest of Wall Street enormously to focus on something called EBITDA, because it results in higher borrowing power, higher valuations, and all of that sort of thing. So it's become very popular in the last 20 years. But it's a very misleading statistic, can be used in very pernicious ways. Charlie, on either one of those subjects?
I think you've understated the horrors of the subject and the disgusting nature of the people that brought that term into the valuation of business. It would be like a leasing broker of real estate you had a 1,000 square foot new suite to be leased, and he says it's got 2,000 feet in it. That's not honorable behavior, and that's the way that term got into common usage. Nobody in his right mind would think that depreciation is not an expense.
Yeah, but it's very much in the interest of Wall Street.
Yes, that's why they did it.
Yeah,
it made the multiple seem lower.
And what's amazing is the way it's accepted, actually. But anyway, it just illustrates how people use language, and sell concepts that work to their own use, and 2 and 20 has the same sort of thing. I mean, the number of people, the amount of money that's overperformed after paying 2 and 20 compared to the expenses that have been incurred, I will assure you, makes for a terrible indictment of that particular arrangement. But as long as it can get sold, it will get sold.
And now they use it in the business schools. Now that is horror squared. I mean, it's bad enough that a bunch of thieves start using a term, but when it gets so common that the business schools copy it, that's not a good result.
Most American corporations separate out supposedly one-time restructuring costs, whereas Berkshire doesn't. Berkshire's reported operating earnings are therefore, in my opinion, of higher quality. Have you ever calculated how much higher operating earnings on average would be if Berkshire separated out plant closing costs, product line exits, severance pay, and similar items? Is it a material number, or does Berkshire not incur much in the way of these types of costs typically because most of your acquisitions are standalone?
Let me take that one. That's a question like asking, why don't you kill your mother to get the insurance money? We don't do it. We're not interested in manipulating those numbers, and we haven't had a restructuring charge ever, and I don't think we're about to start.
Yeah.
I would say this too, Johnny. We don't do that. The numbers would not be huge. You know, there could be a year, I suppose, when they might be for some reason, but they are more conservatively stated than most companies, and I think they're of higher quality. And but I pointed out also that I think that our depreciation expense at the railroad, which is standard and which all the other railroads use, is inadequate as a measure of true operating earnings. But that's
and you're talking about. We like to advertise our defects.
Not all of them. There's no question that I think we will have more amortization of certain intangibles which reduce earnings and reported earnings, but which in reality are not expenses. We'll have more of that than some companies, and I pointed that out. I never want to report one of these things where I have the whole adjusted earnings set out and say this is what you're supposed to pay attention to, because every one of those I've seen virtually results in some inflation of figures, and things are good enough at Berkshire. We don't need to inflate the figures.
Also, would like your thoughts about the some businesses today with their huge inventory write-offs. What your thoughts about those are?
Second question about inventory write-offs. You know, that gets into the category entirely of big bath charges, which are the tendencies of management when some bad news is coming along to try and put all the bad news that's happened into a single quarter or a single year, and even to put the bad news that they are worried about happening in the future into that year. And it leads to real deception in accounting. The SEC has tried to get quite tough on that, but my experience has been that managements that want to do it usually can find some ways to do it. And managements frequently are more conscious of what numbers they want to report than they are of what has actually transpired in a given quarter or a given year.
Warren, in the past, you've enjoyed discussing accounting for options grants. So I'm curious, what's your view of the new accounting standard which mandates that companies report lower tax provisions based on so-called excess tax benefits enjoyed when share-based compensation ends up being more profitable for the grantees than when it's initially modeled? These so-called benefits, excess benefits, used to go through the shareholders' equity line on the balance sheet. Which accounting method makes more sense to you, the old method or the new?
Johnny, I think you know a lot more about it than I do. So if I were asked to answer that question, I'd probably call you up and say, what should I say? It's not a factor that will enter into Berkshire, so I really have not. I mean, I've heard just a little bit about that accounting standard, but I really don't know anything about it. Charlie?
It's not a big deal, Warren.
Yeah, well, I know that. Yeah. There are a few things in accounting we really disagree with, and whether they might be material to somebody trying to evaluate Berkshire, and you know, that primarily gets into amortization of intangibles. It certainly gets into realized capital gains and that sort of thing, and we will go to great lengths to try to tell our partners, basically, not all of whom, you know, are accounting experts or anything, and we will try to make clear to them at least what our view is, you know, the same way as if I had a family business and I was talking to my sisters or something about it. But unless it's material, we'll probably stay away from trying to opine on any new accounting standards. If it's material to Berkshire, we'll go to great lengths to at least give our view. Charlie?
Well, I certainly agree with that.
Okay.
That what he's talking about is not very material to Berkshire.
No, it isn't, and it really won't be. You know.
No.
Some of these others are those, and we will bring those up as they come up. You know, we are reporting $400 and some million less in our earnings than if Precision Cast Parts had remained a public company. Well, is Precision Cast Part, I mean, are the earnings less real? Is the cash less real? Is anything? Because it's moved the ownership? I don't think so. And I want to convey that belief to shareholders, and they can debate whether it's right or wrong. But I think it's a mistake not to comment and just assume that the owners understand that, because it's a fairly arcane point. And so we point it out, but we also point out if we think depreciation is inadequate as for valuation purposes, that depreciation is inadequate at a very capital intensive business like BNSF, which I must say, still love anyway. Starting, I don't even want to tell you about this one, but starting the first of next year, accounting is going to become sort of a nightmare in terms of Berkshire and other companies, because they're going to have us mark our equities to market, just like we were a Wall Street trading firm or something. And those changes in the value of Coca-Cola or American Express or anything are going to run through the income account every quarter. In fact, they run through it every day in this series, so that it really will get confusing. Now, it's our job to explain things so that you aren't confused when we report GAAP earnings. But GAAP earnings, as reported, will become even more meaningless looking only at the bottom line than they are now. And
that was not necessarily a good idea.
No, I think it's a terrible idea, but we'll deal with it. And I mean, it's my job to explain to what extent GAAP accounting is useful to you in evaluating Berkshire and the times when it actually distorts things. Accounting isn't supposed to it's not supposed to describe value. On the other hand, it's a terribly useful tool, if understood, in order to estimate value if you're analyzing businesses. And so in a certain way, you can't blame the auditing profession for doing what they think is their job, which is not to present value, although by using these market values.
But you can blame the audit profession.
What's that?
You can blame the audit profession for that one.
Yeah.
That was really stupid.
Yeah. Well, I agree with that, actually. But we will do our best to give you, always going to give you the audited figures, and then we're going to explain their shortcomings in either direction and what you should use and what you probably should ignore in looking at those numbers and using them to come to a judgment as to the value of your holdings. And I'll explain it to you the same way I would explain it to my sisters or anybody else, that we want you to understand what you own, and we try to cover the details that are really important in that respect. I mean, there's a million things you can talk about that are just of minor importance when you're talking about a $400 billion market value. But they're the things that if Charlie and I were talking about the company, they'd be the figures or the interpretations or anything that we would regard as important in sort of coming to an estimate of the value of the business. But it's going to be, you can't knock the media. I mean, they've only got a few paragraphs to describe the earnings of Berkshire every quarter. But if they simply look at bottom line numbers, what can be silly this year will become absolutely ludicrous next year because of the new rule that comes into effect for 2018. This morning, we posted both our earnings and our 10Q, and if we can put up slide 1, you can take a look at what was reported. And as I warned you in the annual report, a new accounting rule was introduced at the beginning of this year, and it provides that our equity securities, whether we sell them or not, are marked to market every day. So we can have a gain or loss of a couple $2 billion in our equity securities portfolio, and that day, according to the accounting principles now in effect, which are a change, will be recorded as making a couple $1 billion that day or losing a couple billion. And I told you that would produce some very unusual effect from quarter to quarter. And it further explains why I like to release our earnings early Saturday morning, and as well as the 10Q, to give people a chance to read through the explanation. Because if you just were handed this with a TV monitor, at 3:30 in the afternoon or whatever it might be, you would report the net earnings figure understandably very quickly, and it really is not representative of what's going on in the business at all. So if you look at the figure of operating earnings, which is what we look at, we actually earned a record amount for any quarter we've ever had, and that includes no realized gains or losses on securities or on the few remaining derivatives we have. You might leave that slide up there just a little longer. Maybe it is up. The insurance underwriting, GEICO had quite a good size turnaround in profitability, and a good gain, although not as big a gain as last year, which was a record in terms of policies in force. And really throughout most of our businesses, and the details are on the 10Q, which is up on our website now. And as you can see, the railroad was up significantly, and we had most of our businesses tended to be up. Now, we were aided in that in a material way by the reduction in the federal income tax rate from 35% to 21%. Our businesses were up significantly on a pre-tax basis, but the gain was further enhanced by the change in the income tax rate. Now, this morning we posted on our website the quarterly, the 10Q that's required to be filed with the SEC. We published it at 7 o'clock Central Time, and we also published an accompanying press release. And these figures, as usual, require some explanation. As we've mentioned in the annual report, the new GAAP rules, generally accepted accounting principles, require that we mark our securities to market and then report any unrealized gains in our earnings. And you can see, I've warned you about the distortions from this sort of thing. And the first quarter of 2019 actually was much like the first quarter of 2018. And I hope very much that newspapers do not read headlines saying that we made $21.6 billion in the first quarter of this year against the loss of last year. The bottom line figures are going to be totally capricious, and what I worry about is that not everybody studied accounting in school, or they can be very smart people, but that doesn't mean that they've spent any real time on accounting. And I really regard these bottom line figures, particularly if they're emphasized in the press, as potentially being harmful to our shareholders and really not being helpful. So I encourage you now, and I encourage all the press that's here, focus on what we call our operating earnings, which were up a bit, and forget about the capital gains or losses in any given period. Now, they're enormously important over time. We've had substantial capital gains in the future. We have substantial unrealized capital gains at the present time. We expect to have more capital gains in the future. They are an important part of Berkshire, but they have absolutely no predictive value or analytical value on a quarterly basis or an annual basis. And I just hope that nobody gets misled in some quarter when stocks are down and people say Berkshire loses money or something of the sort. It's really it's really a shame that the rules got changed in that way, but we will report. But we will also explain, and we will do our best to have the press understand the importance of focusing on operating earnings, and that we do not attract shareholders who think that there's some enormous gain because in the first quarter the stock market was up. Now, if that's your assumption, and you're already capitalizing those profits at a pretty good multiple, then you have to say that you have to come to the conclusion that the value of American business will grow at a relationship that's not much greater than the growth in GDP. And most of you would estimate that probably to be, maybe 5% a year if you expect a couple percent a year of inflation. So I wouldn't change my thoughts about the profitability of American business over time, and I wouldn't change my thoughts much about the relationship of stock prices over time to those profits. So I would come down very similarly. Now, interestingly enough, some of those same relationships prevailed decades ago, but you were buying stocks that were yielding you perhaps 5% or something like that, so that you were getting 5% in your pocket plus that growth as you went along. And of course, now if you buy stocks, you get 1.5% if you're the American public before the frictional costs, so that the same rate of growth produces a way smaller aggregate return. So, I think stocks are a perfectly decent way to make 6 or 7% a year over the next 15 or 20 years. But I think anybody that expects to make 15% per year, or expects their broker or investment advisor to make that kind of money, is living in a dream world. And it's particularly interesting to me that back when the prospects for stocks were far better, I even wrote something about this in the late 70s, pension funds were using investment rate assumptions that were often in the 6% or thereabout range. And now when the prospects are way poor, most pension funds are using, building into their calculations, returns of 9% or better on investments. I don't know how they're going to get 9% or better on investments, but I also know that they change the investment assumption down, it will change the charge to earnings substantially, and they don't want to do that. So they continue to use investment assumptions, which I think are quite unrealistic. And with companies with a big pension component in their financial situation, and therefore in their income statement, that can be quite significant. And it'll be interesting to me to see whether in the next couple of years, where pension funds are experiencing significant shortfalls from their assumptions, how quickly they change the assumptions. And the consulting firms are not pushing them to do that at all. It's very interesting. The consulting firms are telling them what they want to hear, which is hardly news to any of us, but it's what's taking place.
Yeah, pension fund accounting is drifting into scandal by making these unreasonable investment assumptions. It's just part of the human condition that people extrapolate the recent past. And so since returns from common stocks have been high for quite a long period, they extrapolate that they will continue to be very high into the future. And that creates a lot of reported earnings in terms of pension benefits that aren't available in cash and are likely not to be available at all. And this is not a good idea. And it's interesting how few corporate managements have just responded like Sam Goldwyn, include me out. You'd think more people would just say, this is a scummy way to keep the books, and I will not participate. And instead, everybody just drifts along with the tide, assisted by all these wonderful consultants.
Yeah, I don't know of any case in the United States right now, and I'm sure there are some, but except for the pension funds that we take over, I don't know of any case where people are reducing their assumed investment return. Now, you'd think if interest rates drifted down several percentage points, that might affect what you would think would be earned with money. It certainly is to bondholders, or to us with float or something of the sort. But most major corporations, I believe, are using an investment return assumption of 9% or higher. And that's with long-term governments below 6% and maybe high-grade corporates at 7. They don't know how to get it in the bond market. They don't know how to get it in the mortgage market. I don't think they know how to get it in the stock market. But it would cause their earnings to go down if they change their investment assumption. And like I say, I don't know of a major company that's thinking about it. And I don't know of a major actuarial consultant that's suggesting it to the managements. They'd rather not think about it.
The way they're doing things would be like living right on an earthquake fault that was building up stress every year and projecting that the longer it's been without an earthquake, the less likely an earthquake is to occur. That is a dumb way to write earthquake insurance. And the current practice is a dumb way to do pension fund planning and accounting. Dumb and improper.
If you talk to a management or board of directors about that, you get absolutely no place.
Their eyes would glaze over before the hostility came. And the man asked the question also, it says, what remaining big accounting troubles exist? The real lollapallooza is pension fund accounting and to some extent post-retirement medical liabilities. Those are horribly understated now in America, and they're very big numbers.
I've looked at financial statements, and you've seen them too in the last few months, where companies are recording pension income in the hundreds of millions while at the same time being underfunded in their pension plan in the many billions. And they just aren't facing up to reality at all, and they don't want to because they don't want to take the hit. And they're this, it's the same mentality as stock option expenses, and they are paying people with stock options, but we pay people with cash bonuses. And I suppose we might, well, it isn't really true, but we might like it if we didn't have to record cash bonuses as an expense. I mean, it's a way we pay people. And you can say, well, why don't you put it in the footnotes and leave it out of the income account like they do with option expenses, which is a form of compensation too. But the answer is that a bunch of people who cared very much about having their stocks float to unreasonable prices, at least in our view, found they could do it a lot easier if they didn't count compensation expenses. And why not put all expenses in footnotes? Just have an item there that says sales and then have the same figure for net profit, and then just have all the expenses in the footnotes. And people with a straight face, say, well, it's in the footnotes, so therefore everybody knows about it, and we don't have to count it, put it in the income account. It's amazing what people with high IQs will do to rationalize their own pocketbooks. And Charlie has another explanation for why there's been this denial of the reality of option expense in terms of people's ego getting involved with their own records. And you want to elaborate on that, Charlie? Don't name names.
Well, no, I'm so tiresome on this subject, and I've been on it for so many decades. It's such a rotten way to run a civilization, to make the basic accounting wrong. It is very much like making the engineering wrong when you're building a bridge. And when I see reputable people making these perfectly ridiculous arguments to the effect that it's unthinkable that options be expense.
Or it's too difficult to value.
Well, because it's too difficult to value, or God knows what reason. And a lot of them are people you'd be glad to have marry your daughter. And
yeah, because they're rich, for one thing.
Yet the truth of the matter is they're somewhere between crazy and crooked.
Put him down as undecided.
Question has to do with how the FASB has caved in on the stock option proposal, and the people opposed to the proposal argue that it would hurt capital formation for companies, and that the cost of stock options is already reflected in shares outstanding in fully diluted calculations. And I was curious, what is your feelings about what's happened?
Well, as those of you who followed this issue, the FASB did cave in it. They hated it. I mean, they knew they were right. As a matter of fact, most of the what are now, I guess, the big 6 auditing firms, are big. Many years ago, sided with the position, but in my opinion, the auditing firms caved to their clients in that respect. And in terms of capital formation, I would argue that the most intelligent form of capital formation follows from the most accurate form of accounting. I mean, if all the companies whose names began with A through M didn't have to count depreciation, and all the ones with N through Z did or something, that might help in capital formation for companies that had names with A through M, and incidentally, they probably all changed their names. But I don't think that bad accounting is an aid to capital formation. In fact, I think probably over time it distorts capital formation, because if we were to pay all of the shareholders all of the people who worked for Berkshire Hathaway in stock, and therefore record no wage expense, we might be able to sucker in a bunch of people who thought the earnings were real, but that would not be a great step forward for capital formation, in my view. I really think that, I've talked privately to a number of managers about this, and they understand it, but they prefer the present situation, and they used a lot of muscle in Washington. Many years ago, and I think I have this authenticated now. This fellow mathematics professor sent me some material after I'd written this. I try to get a little proof after the fact when I can. I believe it was in the Indiana legislature, where a legislator introduced a bill to change the value of pi, the mathematical symbol pi, to 3, because he said that it was too difficult for the school children to work with this complicated 3.14159. And he was right. I mean, it was difficult. And Congress, in connection with the stock option question, received all kinds of pressure to in turn pressure FASB and the SEC to not count stock option costs as part of compensation. I've never met anybody that wanted to be compensated that felt that if he received his present salary plus an option, he was not getting compensated more than if he just received the salary. So he thought it was compensation. And I will tell you that if we'd been issuing options over a period of time at Berkshire for things unrelated to the performance of the entire business, that we would have had a cost perhaps measuring in the billions of dollars, whether it was recorded or not. So it goes back to Bishop Berkeley's question of whether a tree that falls in the forest and doesn't make a sound, et cetera. But I think it is. I really think it makes you a bit of a cynic about American business when you see the extent to which a group has pressured, even to the extent of talking about withdrawing financial support from the Financial Accounting Standards Board, the degree to which they've pressured people to make sure the value of pi stays at 3 instead of 3.14, simply because it was their own ox that was being gored a bit. In any event, it looks like it's all over now for some time. In fact, now they're pressuring them to even weaken further the standards that have been set. So self-interest is alive and well in corporate America. Charlie?
Yeah, I think dishonor won. And I think that it is quite important for a civilization to have sound engineering and good accounting. And it is a very regrettable episode. Leading politicians, leading venture capitalists. I think to some extent it's an indictment of the educational system that this thing could be so widely looked at and so wrongly. I mean,
it's bad enough people want to cheat on their accounting, and they do cheat on their accounting, but to want it to be endorsed as the system is really kind of disgusting.
Yeah, corruption won.
My first question is on the quality of earnings and your evaluation of quality of earnings in the U.S. right now.
Now, as to quality of earnings, Charlie and I feel that in several respects, but in one important respect, that the quality of earnings has gone down, not because the policy has changed, but because it's just become more significant, and that's in the case of stock options. There are certain companies that we've evaluated for possible purchase where in our calculation of earnings, the earnings are maybe 10% less per year, per share, than reported. And that isn't necessarily the end of the world, but it is a difference in valuation that is significant and is not reported under standard accounting. So we think the quality of earnings as reported by a company with significant stock option grants every year, we think is dramatically poorer than one where that doesn't exist. And there are a lot of companies that fall in that category. Coca-Cola's earnings are very easy to figure it out. Just figure out what they're earning per case from operations, and you'll see over the years the earnings per case go up, and the cases go up, and the shares go down. And it doesn't get much more complicated than that. Charlie?
You've said it wonderfully. I just wish we had more like that.
Yeah. GEICO, the key, I mean, the same way as policies in force and underwriting experience per policy. And that is exactly the way, as noted in the annual report, we pay people there. We pay them from the bottom to the very top based on what happens with those two variables. And we don't talk about earnings per share at GEICO, and we don't talk about investment income. We don't get off the track because there are two things that are going to determine what kind of business that GEICO is over a long period of time. And policies at GEICO are unit cases at Coca-Cola.
Also, what quantitative method would you suggest that investors use for expensing the option grants of publicly traded firms where there is no realistic prospect for the substitution of such an options program with a cash-based performance incentive plan? In other words, how do you derive the 5 to 10% earnings dilution referred to in this year's Berkshire's annual report? And is it possible that the dilution figure could be even higher than that? Thank you.
Okay. The question about how we charge for stock options is very simple. If we look at what a company issues in options over, say, a 5-year period and divide by 5 because the grants are irregular, or whatever, if there's some reason why that seems inappropriate, we might use something else. But we try to figure out what the average option issuance is going to be. And then we say to ourselves, how much could the company have received for those options if they'd sold them as warrants to the public? I mean, they can sell me options on any company in the world. I'll pay some price for an option on anything. And we would look at what the fair market value of those options would be that day if they were transferable options. Now, they aren't transferable, but they also, employees sometimes get their options repriced downward, which you don't get if you have public options. So we say that the cost to the shareholder of issuing the options is about what could be received if they turned those options into warrants and sold them public or sold them as options. And that's the cost. I mean, it's a compensation cost. And just try going to a company that's had a lot of options grants every year and tell them you're going to quit giving the options and pay people the same amount of money. They'll say you took away part of my earnings. And we say if you've taken away part of the earnings, then let's show it in the income account and show it as a cost, because it is a cost. And I think actually a number of auditors agreed to that position many years ago, and they started receiving pressure from their clients who said, gee, that might hurt our earnings if we reported that cost. And the auditors caved, and they put pressure on Congress when it came up a few years ago, and I think it's a scandal, but it's happened. We are going to, in evaluating a business, whether we're going to buy the entire business or whether we're going to buy part of it, we're going to figure out how much it's costing us to issue, and when the company issues those options every year, and if they reprice them, we're going to figure out how much that particular policy costs us, and that is coming out of our pocket as investors, and I think people are quite foolish if they ignore that. I don't think it's going to change. It's too much in corporate America's interest to to keep it out of the income account and keep issuing more and more options percentage-wise and not have it hit the income account, and to reprice when stocks go down. But that doesn't make it right. Charlie?
Yeah, I go so far as to say it's fundamentally wrong not to have rational, honest accounting in big American corporations. And it's very important not to let little corruptions start because they become big corruptions, and then you have vested interests that fight to perpetuate them. Surely there are a lot of wonderful companies that issue stock options, and the stock options go to a lot of wonderful employees that are really earning them. But all that said, the accounting in America is corrupt, and it is not a good idea to have corrupt accounting.
You can see the problem of the creep in it once it starts. It's much like campaign finance reform. I mean, if you let it go for a long time, the system becomes so embedded in it, and the participants become so dependent upon it that it becomes a huge constituency that will fight like the very devil to prevent any change, regardless of the logic of the situation. I mean, once you get a significant number of important players benefiting from any kind of corruption in any kind of system, you're going to have a terrible time changing it. That's why it should be changed early, and it would have been easier to change the accounting for stock options some decades back when it was first proposed than now, because basically corporate America is hooked on it. This does not mean that we are against options per se. If Charlie and I died tonight, and you had two new faces up here who didn't have the benefit of having bought a lot of Berkshire a long time ago, and they had responsibility for the whole enterprise, it would not be inappropriate to pay them in some way that was reflective of the prosperity of the whole enterprise. I mean, it would be crazy to pay the people at Dairy Queen and options of Berkshire Hathaway, or pay the people at Star Furniture, or any one of our operations, because they have responsibility for a given unit, and what the price of Coca-Cola stock does could swamp their efforts in either direction. It just would be inappropriate. But it would not be inappropriate to pay somebody that's got the responsibility for all of Berkshire in a way that reflected the prosperity of all of Berkshire. And a properly designed option system, which would be much different than the ones you see, because it'd be much more rational, could well make sense for one or two people that had the responsibility for this whole place. Charlie and I aren't interested in that, but I think that you may be looking at two people up here 50 years from now, I hope, that where it would be appropriate. But any option system, should not involve giving an option at less than the place could be sold for today, regardless of the market price, because once management's in control, it can make that decision, and it should reflect the cost of capital. And very, very few systems reflect the cost of capital. But if we're going to sit here and plow all the money back every year into the business, and you're, in effect, use your earnings interest-free to increase our own earnings in the future, we think there has to be a cost of capital to have a properly designed option system. People aren't interested in that. The option consultants aren't interested in that, because that isn't what their clientele wants. Charlie, you probably wound up a little more now on this too, aren't you?
No, I've wound up enough.
Okay.
The area that I'd like to inquire about is stock options. As you are aware and have written about in the past reports, companies have been taking advantage of and contributing to FASB's inadequate rules regarding stock options. In particular, the lack of having to expense them on the income statement and the lack of having to report them as a liability on the balance sheet. My question is, are either one of you doing anything to help FASB's current stance on the issue? If not, have either one of you ever considered establishing a, quote, real, end quote, independent body of accountants that would actually try to make companies produce accounting statements that reflect economic reality?
Charlie, I'll let you get the history on it.
Well, we don't like the accounting, which we've called corrupt, or at least I have. And I don't think that's too strong a word. I think it's corrupt to have false accounting because you like a certain outcome better than another. All that said, I don't think either of us spends a lot of time fighting with FASB or trying to create a better one. It's like splintering your lance against stone or something. You'd get a lot of back pressure from the butt of the lance, and we can't be expected to cure all the ills of the world.
We've written about it and talked about it. Obviously, you've picked up on it, and when it was an active issue, whenever it was, about, I don't know, 4 years ago or so, Senator Levin of Michigan was one of those who felt as we did, and of course FASB felt as we did. But the pressure was incredible that American business brought on Congress. They weren't getting. They tried to put pressure on FASB and they weren't getting a result. So they just said, well, we're not going to let FASB set the accounting rules. We'll have Congress set the accounting rules. And I thought that was a bad idea per se. But I thought in this but they got plenty of supporters. Got a huge number of supporters. I mean, and at the time I compared it, I think there was a bill introduced in the Indiana legislature in the 1890s, I believe, and the bill was to change the value of the mathematical term pi to 3 even instead of 3.1415. And the legislator who introduced it said that it was too difficult for the school children of Indiana to work with this terribly long, unending term, and it would be so much easier if pi was just 3, and he thought that they ought to enact that. Well, I thought that was quite rational compared to what the Congress of the United States was going to do, in telling people that since one of the arguments was that it makes it very tough for startup companies if they have to expense this. Well, it makes it tough if they have to pay their electricity bill too. But I mean, but those were the kind of arguments you got. And my memory is, Charlie is better on this than I am probably, but I think the accounting firms 40 years ago or 50 years ago were in accord with our position. But every client would put pressure on, and they don't want to report expenses. They particularly don't want to report expenses that are paid to them, and that can be huge, and that might prove obnoxious if recorded by conventional accounting, but if it's sort of lost in a table in the proxy statement, people don't pay much attention. So the only way it will get changed, we wrote about it, and I even talked to a few senators at the time. The only way it'll get changed is and this is the only way corporate governance problems generally will get changed, if 15 or 20 large institutional investors would band together in some way on this. But some of them have the same problem because they're getting paid extraordinary sums for doing something that is really not adding that much value. So they're not really inclined to call attention in many cases to what Charlie would refer to as obscenities in other people's compensation. So I think it's going to go on. I mean, it's a fascinating subject, but the institutional investors seem to focus very much on matters of form and not substance. I mean, you get a lot of they cluck a lot about little things that don't have anything to do with their economic return over time. Whereas on stock options, there's something that's terribly important. They're the ones that are paying the costs, and the costs are there whether they get recorded or not. But American management will not change its position on that voluntarily. Consultants will never change their position. They're getting paid to encourage people to look at other companies, and it just keeps ratcheting up. So I don't think you're going to see change unless institutional investors do it. And as I say, I get these questionnaires, about the composition of the board or a nominating committee. None of that makes any difference in terms of how a business performs. Got one form. It said they wanted a list of directors broken down by sex, and I said none that I know of. But it just is not germane. Charlie?
Yeah, right. Well, I can't top that one.
I have a question related to an issue you touched on a few moments ago. on the debate over whether or not stock options should be expensed and reflected on the income statement of companies. With the current system, shareholders are incurring the burden of stock options since exercised options dilute earnings per share. As a shareholder of companies that issue stock options, I think I'm okay with that, especially in entrepreneurial companies that may not have enough cash to attract talent from larger competitors, or in cases where you have younger employees or lower level employees who do not have the cash to purchase stock without the use of options. I have a two-part question. If companies are required to expense stock options and it impacts the P&L, would that lead to double counting the impact of stock options? And the second part is, if the use of stock options are largely eliminated, might that impact the competitiveness of entrepreneurial companies which help drive innovation and growth and create more of a dividing line between shareholders and employees?
Yeah, the first question is that there really isn't the double counting necessarily. For example, let's just take a company with 1 million shares of stock outstanding, selling at $100 a share. And let's say that options are granted for 9 million shares. We'll make it extreme at $100 a share. At that moment, you've given 90% of the upside to the management. We're taking a very extreme example. That's been a huge cost to the shareholders. Now, interestingly enough, if the stock was selling at $100 a share, the fully diluted earnings are exactly the same as the basic earnings in that year, because the dilution is not counted at all unless the stock is selling above, and then only by the difference in the market value and what it costs to repurchase the option shares. So there is not double counting, and you could issue, the very fact that you issued that the options on 9 million more shares at 100 would undoubtedly cause the price to actually fall well below 100, and there would be no dilution shown in terms of the way GAAP reports diluted earnings. The second question is to whether if you expense the options, it would discourage the option use. Well, the argument that is made when people issue options is doing more for the company than giving people cash compensation. Maybe more convenient to cash compensation too for young and upcoming companies. But the fact that you are doing something in terms of paying people in a way that you say is even more effective than paying them in cash, to say that therefore you shouldn't have to record the payment, I've never really followed it. I don't have any objection to options under some conditions. I've never taken a blanket position that options are sinful or anything of the sort. I just say they are an expense. And to be truthful with people about what you're earning, you should record the expense. And if a company can't afford to be truthful, I have trouble with that. And we will take, as we've said, you can pay your insurance premium to me in options. There'd be lots of companies I'd be happy to take options in and give them credit. I take options above the market. Give me a 10-year option 50% above the market in many companies, and we will take that appropriate number of shares in terms and take that in lieu of cash. But that means we would simply like the value of what we're getting better than the equivalent amount of cash, and we think the company that gives it to us has incurred an expense. We say something of value, they've given some value up, and that's income to us and expense to them. And I think all of the opposition at bottom to expensing of options comes from people who know they're not going to get as many options if they're expensed, and they would like cash not to be expensed, but they can't get away with that. If you had an accounting rule that said the CEO's salary should not be counted as in cash, believe me, the CEOs would be in there fighting to have that rule maintained. Because they would feel that they were going to get more cash if it wasn't expensed, and options are the same way. It's another argument I get a kick out of. I just reading it the other day where they say, well, options are too tough to value. Well, I've answered that in various forms, but I noticed that what is it? Dell Computer, has a great number of put options out, and it's going to cost them a lot of money on the put options they have out. And for a company to say we can't figure out the value of options and therefore we can't expense them, and then at the same time dealing in billions of dollars worth of options, they are saying we are out buying or selling options in the billions of dollars, but we don't know how to value these things. That strikes me as a little bit specious, a little disconnected, cognitive dissonance, as they say. Charlie?
Yeah, I'm not at all against stock options in venture capital, for instance. But the argument that prominent venture capitalists have made that not expensing stock options is appropriate because if you expense them, it would be counting the stock options double. That's an insane argument. The stock option is both an expense and a delusion, and both factors should be taken into account in proper accounting. John Doerr, the venture capitalist, as he argues to the contrary, is taking a public position that were it offered to me as part of my employment, I would rather make my living playing a piano in a whorehouse.
We always get to the good stuff in the afternoon. I hope the children are in bed. It's really astounding. The interesting thing is, of course, now is that the 4 auditing firms left, what they call the final 4 now in the auditing they have now, and listen, I'm glad they did it too, and I tip my hat to them for doing it, but they've now said that they really do think options are an expense. So this is, that it kind of reminds you of what happened during the Reformation, isn't it? When you'd have these places sway back and forward, as they get carried by one argument or the other. In fact, I think there was that famous vicar of Bray who would swing from Catholicism to Luther back and forth as this little town went back and forth in Germany. And finally the townspeople gathered and they said to the vicar, they said, it's understandable that we're confused by all that's going on in theology and we really don't know much about it, and so we swing back and forth. But they said, we find it a little disgusting that you, a man of the cloth, would also keep swaying back and forth. And they said, have you no principle? And he said, yes, I have one principle. He says, it's to remain the vicar of Bray. Well, I think we've seen a little of that in the auditing profession, but I think they've actually found the true religion now. So I don't want to sit here and criticize them, but you now have 4 firms that lobbied against options being counted as an expense in 1993 that have written the FASB and say that options should be an expense. And I don't know how in the world something could have not been an expense in 1993 and be an expense in 2003. It certainly didn't apply to utility bills or, raw materials or anything of the sort. But that's the human condition. And that leads me into, I ran into a friend at the lunch break who's involved in these matters, and he suggested, and I'm delighted to put in a plug to encourage all of you to write your congressmen and senators to give your views on whether stock options should be expensed or whether indeed whether Congress has got any business legislating on the question of what proper accounting is. It was a disgrace some 10 years ago when the United States Senate essentially threatened the Accounting Standards Board with extinction and bludgeoned Arthur Levitt, then running the SEC, at the behest of a lot of rich contributors to declare that to override the Accounting Standards Board's pronouncement that options should be treated as expense. And I think in a very significant way it accelerated the anything goes mentality of the 1990s. At that point, when Congress says it's more important to have stock prices go up than it is to tell the truth, and they voted 88-9 in order to do it, as I remember, I think there was a shift in morality among many corporate executives. You may remember that the FASB then backed off, but still said that expensing was preferable. And having said it was preferable, 498 out of the 500 companies in the S&P took the less preferable method. All of the big auditing firms at that time endorsed their big clients' views in order to report higher earnings. Now all 4 accounting firms say you should count them as expenses. Well, they're right now, but it just shows what was going on in that period when, on a question of accounting principles, and when really nothing has changed, when what were then the big 5 have shifted 100% to where the big 4 are now, and now they say options should be expense. So if you are inclined to write your congressman or senator, tell them you really think the FASB knows more about accounting than they do, and I think you'll be right. If you want to have some fun, go to Google and type in 2 words. Type in the word Indiana and type in the word pi. That's the mathematical symbol pi. And when you do that, you'll see a number of stories come up. And they relate how in 1897, at the instigation of one legislator who was responding to a constituent, the House in Indiana voted almost unanimously, may have even been unanimously, it says what it was on Google, to change the value of pi. I'm not making this up. It's checkable. And it seems that there was a fellow that had thought he'd discovered some new relationship between circumference and diameter and area and a few things. And it came out to 3.20 if you work through his formula. And he offered to give this royalty-free, as he put it, to the state of Indiana to teach its children so that they would have not only the truth, but they'd have an easier number to work with than the long decimal that heretofore had been thought of as pi. Well, that passed the Indiana legislature, and it passed the House. By the time it got to the Senate, there were a few people that were still clinging to the old values who managed to shoot it down. But I would submit that in 1993 that the U.S. Senate cleansed the record of the Indiana legislature by outdoing them in attempting to change the rules on a subject they knew nothing about. And I think some of the excesses of the 1990s that followed came about through the fact that they knew 88 senators were willing to declare the world was flat if constituents who had contributed enough money to them wanted it thus. We pause now. We'll get back to our schedule here. Number 3. Oh, Charlie, do you have anything to say about the Indiana legislature?
Well, the current members of Congress that want to retain the former abusive accounting, which are probably a majority of the House of Representatives, are way worse than the people who wanted to round pi to an even number. Those people were stupid. These people are mostly not stupid, but dishonorable. I mean, they know it's wrong and they want to do it anyway.
I'm nervous about the derivative operations that General Re has. Now, right now, the balance sheet figure says that there's a $400 million net asset position, but there are also some really hairy derivatives, the swaps and the floors and caps. And knowing that in the past you haven't used those types of leveraged derivatives, I'm wondering if that's going to change now.
The question about the derivatives business is a good business. It's a good question because it involves big balance sheet numbers and big off-balance sheet numbers in relation to the amount of money made, and particularly in relation to the amount of money made in terms of the capital employed and the credit guarantees, the long-term nature. All of that makes that something that we do want to look at always very hard. It's a business that people can get in trouble in, and they can get in trouble while the accounting sails along merrily. I remember when Charlie and I were at Solomon, we didn't find it, other people found it finally, but mismarked derivative positions that were very substantial that had gone on for a long period of time, and this was with paying a lot of money to auditors to look at them. Am I right about that, Charlie, on that? Charlie was on the audit committee.
The worst glitches were that the books just got so out of control, not in the derivative department, that there were just multi-million-dollar errors.
But we found mismarks, as I remember,
yes,
in the 20-odd millions on positions.
Yes,
and
both.
In some cases, because the contracts got so complicated that the people that were valuing them didn't understand them, and at least partially didn't understand them. I mean, there's a lot of potential for mischief when people can write down a few numbers on a piece of paper and nothing changes hands for a long time, and their compensation, next month and this year depends on what numbers are attached to a bunch of things that are not really, where they don't come to fruition for a long time, and particularly when you're guaranteeing credit or anything of the sort. So you're very correct in observing that when the numbers are big in relation to the amount of profit, you want to look very carefully, because if anything goes wrong, it could go wrong on a fairly big scale, and you're not getting paid a lot for running that type of risk.
Insurance companies, could you comment on insurance companies taking on credit risk through the sale of credit derivatives, the adequacy of the accounting for these derivatives?
Yeah, he also asked about the quality of accounting, and in my view at least, the quality of accounting in America for derivative transactions is still terrible, and it's terrible in that it's too optimistic. And one of the places where it's most terrible is when you talk about guaranteeing future credits way out, years ahead. That sort of thing just lends itself to people getting very optimistic in their assumptions and in their audited figures. And people pay attention to the audited figures, not the underlying reality. So therefore, if the accounting is lousy, the business decisions are lousy. And I think that's going on mightily as we sit here.
Yeah, there are dozens of insurance organizations or trading organizations in the country that have written credit guarantee contracts in derivative form in the last few years, in fact, on a huge scale. I will guarantee you virtually that every single one of those contracts that was written in the first week, whoever wrote it, recognized some sort of an income account or an income entry, and that somebody got paid a little bit of money for writing each one of them. And you know that many of those are going to go bad, and maybe as a category that it's going to be a terrible category. But nobody ever wrote a contract and recorded a loss at the time they wrote it. I mean, they just don't do it. And I will tell you that there are a lot of those contracts that if somebody wrote them for me, 10 seconds later, I would have paid somebody to take them off my hands, so that I would have regarded them as having a built-in loss. Nobody ever records a built-in loss on a derivative contract. In fact, I find it extraordinary that you have two derivative dealers, and dealer A and dealer B write a ticket, and dealer A records a profit and dealer B records a profit, particularly if it's a 20-year contract. I mean, that is the kind of world I'd love to live in, but I haven't found it yet.
The other aspect is about derivatives, the potential weapons of financial mass destruction. For those derivatives which don't have quotes, I suspect we could find out how big a black hole there might be if the regulators around the world required everyone to report at the same date for each derivative they have their current recognized asset or negative asset, and most importantly, who the counterparty was. So the regulators, sharing information collected from both sides, could see what the worldwide aggregate misstatement was.
The derivatives question you raise is really interesting, but it would be mind-boggling to implement. I mean, it's always fascinating to me how people can write a derivative contract, and both sides of it, the trader will be perhaps at least showing a profit on it, by the end of the month or something of the sort. Now, usually the contracts aren't that precisely matched because you have all kinds of other contracts that bear on the one you're doing. But I would say that the trader's estimate and maybe the auditor's estimate of the value of all derivatives, contracts outstanding in the world, would end up with quite a large positive sum for something that essentially will wash out as a zero sum. And I can tell you from the fact that I inherited a book of 23,000 contracts that's far, far, far from the largest or the second largest or the third largest in the world, and the complexity of those contracts and the complexity of unwinding them now, where we're 3 years into it and we've done an awful lot of it, but we've been operating in a benign environment. I don't think any regulator, and I'm not sure any auditor, when you get up to really extensive derivative books, in effect can get their minds around evaluation. I know that, as I pointed out in our report, ours were supposedly marked to market, and people think of that as something that you just go out and hit bids and, within a few days wind up something. And if you're trading government bonds, you can do that. And if you're trading actually active equities, you can do it. But when you start trading derivatives, it's unbelievable what you can find, and I've had a couple of experiences with that. Charlie, what are your thoughts?
Well, my thoughts are that stupid and dishonorable accountants allowed the genie of totally improper accounting to come out of the bottle and descend in the derivative books of the world. Once that has happened, and people have used it to create masses of assets and masses of earnings reports and bonuses and status and so on and so on and so on, getting the genie back in the bottle is no small task, because you have these huge vested interests who are fighting you. And what ordinary housewife, as she puts the toast in the morning, is thinking, my God, I've got to do something about derivatives. So the people that have vested interests in the current system are powerful, and the rest of the people don't care. And so this evil genie stays out of the bottle and does more and more mischief with each passing day. If you're trying to fix this, you are going to have a very interesting life.
Many years, both of you have been warning about the dangers of derivatives, at one point calling them financial weapons of mass destruction. Yet every year, tens of trillions of dollars of derivatives are bought and sold. It just seems to be getting bigger and bigger, and almost certainly improperly accounted for. And so I was wondering if you could comment specifically if you have any thoughts on how much longer this might go on. Do you see anything imminent that could derail this ever-inflating bubble? What might trigger it? And who should be doing what to try and mitigate this looming danger?
Yeah, and of course the accounting being deficient enormously contributes to the risks. If you get paid enormous bonuses based on reporting profits that don't exist, you're going to keep doing whatever causes those phony profits to keep appearing on the books. And what makes that so difficult is that most of the accounting profession doesn't even recognize how stupidly it is behaving. And one of the people in charge of accounting standards said to me, well, this is better, this derivative accounting, because it's mark to market. And don't we want current information? And I said, yes, but if you mark to model and you create the models and your accountants trust your models, and you can just report whatever profit you want as long as you keep expanding the positions bigger and bigger and bigger, the way human nature is, that will cause terrible results and terrible behavior. And this person said to me, well, you just don't understand accounting.
If 4 years ago or whenever it was when we started to liquidate Gen Re's portfolio, we had reserves set up for in the hundreds of millions and all sorts of things. And our auditor, and I emphasize any other of the big four auditors, absolutely would have attested to the fact that our stuff was marked to market. I just wish I'd sold the portfolio to the auditors that day. I'd be $400 million better off. So it's a real problem. Now, there's one thing that's really quite interesting to me. If I owe you on my dry cleaning bill or something $15 and they're auditing the dry cleaners, they check with me and they find out that I owe you $15 and it's all fine. If they're auditing me, they find out that I owe the dry cleaner $15. There are only 4 big auditing firms, basically in this country. And so in many cases, if they're auditing my side of the derivative transaction, what I'm valuing it at, the same firm may often be valuing or attesting to the value of the mark by the person on the other side of the contract. I will guarantee you that if you add up the marks on both sides, they don't equate out to zero. We have 60-some contracts, and I will bet that people are valuing them differently on the other side than we value them themselves, and it won't be to the disadvantage of the trader on the other side. I don't get paid based on how ours are valued, so I've got no reason to want to game the system. But there are people out on the other side that do have reasons to game the system. So if I'm valuing some contract at plus $1 million for Berkshire, that contract on the other side is just one piece of paper. It should be valued at a minus $1 million by somebody else. But I think you probably have cases, and I'm not talking about our auditors, I'm talking about all 4 of the firms. But they have many cases where they are attesting to values of the exact same piece of paper where the numbers are widely different on both sides. Do you have any thoughts on that, Charlie?
Well, as sure as God made little green apples, this is going to cause a lot of trouble in due course. As long as it keeps expanding and ballooning and so on, and the convulsions are minor, it can just go on and on. But eventually, there will be a big denouement.
Tam Brands and U.S. Tobacco are 2 companies which are primarily single focused product companies that seem to possibly have some barriers to growth in unit sales and pricing, and have employed a strategy of returning cash to shareholders through stock repurchases. Both companies have at times when they thought the stock was at a discount to intrinsic value used debt to accentuate their repurchases. Those companies recently have talked about problems with going into a negative stated shareholders equity position through the use of additional debt to repurchase more shares at a time when both companies believe their stock's very cheap, and they appear to have the type of long-term cash flow that would at least allow that. Would you comment on the at least accounting treatment and the stated shareholders equity, and if you think that should be a real concern for management in those areas?
What was the first company besides U.S. Tobacco?
Tam Brands.
Tam Brands?
Yes.
Yeah, I don't think there's anything magic about whether shareholder equity is positive or negative. The Coca-cola has a shareholder equity of $5 billion. It has a market value of $75 billion or so. Now, they're not going to do it, and I'm not going to recommend it, but if they were to spend $10 billion buying in their stock, they would have a negative shareholders equity of $5 billion. Their credit would be sound. I mean, if somebody else were to buy the company for $75 billion, they'd have $5 billion of tangible assets and $70 billion of intangible assets. And there is nothing magic about a company having a positive shareholders equity, and it isn't done very often, and I can't even think of a case where it's been done, but it may have been. But I see nothing wrong with a company having a negative shareholders equity, although it may be prohibited by the state in which they're incorporated in terms of repurchasing shares at a time that would produce that. You have to look at the state law on that. But any time a company in an LBO or something is bought out at some very large number over book value, in effect they're creating a negative, if they borrow enough money on it, they're creating a negative shareholders equity in terms of the previous shareholders equity. It's just a fiction as to the numbers between the two organizations. You should buy in your stock when you don't have a use for the money, and that could be management specific. I mean, some managements might have a use for the money if their field of capital allocation were large enough, whereas another management that was more specialized in their own business might not. But once a company has attended to the things that are required or advantageous for the present business, we think reacquisition of stock is a very logical thing to consider, as long as you don't think you're paying more than the intrinsic value of the business in doing it. And obviously, the bigger the discount from intrinsic value, the more compelling that particular use of money is. Charlie?
I've got nothing to add. Generally speaking, maybe Coca-Cola can have a negative equity, but I don't think it would be a good idea for General Motors. I think there's something to be said for a positive shareholders' equity.
One aspect is about how insurance liabilities and assets are valued for solvency purposes, and the discussions that are going on to develop new accounting standards worldwide. On insurance solvency, if we started with a fair attempt at mean discounted liabilities and then added a large chunk for safety, and for reinsurance assets did the same, discounted, but this time the safety chunk was deducted, life would be a lot simpler and there would be a lot more consistency and, I suspect, safety than under the current undiscounted regime.
Well, on the subject of discounting reserves, which essentially means taking what you expect to pay in the future and then taking the appropriate interest rate and carrying at some lower figure now because you don't have to pay now, but later, I can certainly make the purist argument, or the argument of the purist, for the fact that that might be the most accurate way, and certainly, of course, in the life insurance field that it's prevalent. But I would say there has been such a tendency of managements to understate reserves worldwide, and in some cases by extraordinary amounts, that I think anything that pushes in the direction of carrying those reserves at even lower amounts, and I realize you stuck in that part about the healthy bumping of them too, but I think anything that any accounting that gives people a rationale for making reserves even lower than they have been on balance is dangerous. There is such a tendency on what they call long-tail business, or business where you don't expect to actually make the payments for a few years or more. I think there's such a tendency to view those with optimism, particularly when somebody's going to retire in a couple of years or their options are about to run out or whatever it may be, that I don't like giving them the extra leeway of discounting on top of that.
Yeah, I see it at Costco, where there's been almost no inflation in the composite product that flows through Costco. And yet in other places you get these dramatic rising figures. I don't feel sorry for the people that pay $27 million for an 8,000-foot condo in Manhattan. You know, if they've had little inflation, I guess it doesn't matter to the rest of us. But it's almost weird the way the situation works in terms of how it comes in just a few places.
If you look at the Costco annual report or the Walmart annual report, these are huge enterprises, and you'll see their LIFO adjustment is just peanuts.
Almost nothing.
Yeah, just peanuts. Is Costco on LIFO for fuel? Oh, I know they're on LIFO generally. Are they on it for gasoline or not?
I think so. I can't imagine they're not.
Yeah, but they wouldn't have a large inventory relative to their sales volume. But at Walmart, it's inconsequential. I just got through reading their annual report, and the LIFO adjustment isn't worth a hiccup, basically. And you were dealing with $300 billion, well, in the United States a little less than that, but $200 and some billion worth of sales, and the LIFO adjustment would have picked up changes in prices of that mix overall relative to their inventory level. So in jewelry, because of gold and some things, we had some big LIFO adjustments last year. Steel, we've had big LIFO adjustments. We have a steel service center in Chicago, and we buy a lot of steel at MyTech. and there's a big LIFO adjustment. So it's very uneven. Carpet went no place for 20 years, but because it's petrochemical based, there have been substantial price changes in the carpet business in the last couple of years. And our LIFO, we had a LIFO, a minus LIFO figure in effect 3 years ago, and now we have 100 million or so of LIFO adjustments. So there's been a significant price change there.
For a variety of reasons, bonus depreciation on fixed assets investments in the non-insurance businesses perhaps being the most important, Berkshire's cash taxes have been meaningfully lower than reported taxes for the last several years. The cumulative difference between cash taxes and reported taxes, which could be viewed as another form of float, now stands at around $37 billion. Do you consider any portion of the cash flow from annual increase in deferred taxes to be economic earnings? Is this a sustainable dynamic, or do you expect the relationship between cash and reported taxes to ever flip, for instance, if bonus depreciation ever expires? Given Berkshire's massive appetite for capital spending at the utility and the railroad, is it possible instead that its deferred tax liability will never have to be paid no matter what Congress does with bonus depreciation? And is it perhaps even likely that this form of float will continue to grow?
Probably the most likely answer, there's two forms of it, float from deferred taxes. One is the unrealized appreciation on securities, and there, who knows what happens. I don't think the appreciation is going to disappear, but we may decide to realize some of it from time to time. In fact, we could realize a lot of it. If you move over to the depreciation, which you're talking about on the $37 billion, because the total deferred taxes, as I remember, up maybe $60 billion or something like that. That is a factor of accelerated depreciation. And one form or another of accelerated depreciation has been around a long time. Occasionally, I think the bonus depreciation one year went to 100%. I could be wrong on that. Certainly in our utility business, that helps our customer and it doesn't help us, basically. I mean, we will get a return on equity, and that's not free equity to us or anything of the sort. The regulatory commissions take that into account. Return on invested capital in terms of how the Surface Transportation Board would look at it, again, I don't think we benefit enormously by that. It does mean there's less cash going out the door, and we therefore don't need to borrow as much money for capital investment as otherwise. But I don't think I would look at that as a hidden form of equity. I'd rather have the deferred taxes than not have them, but it's not meaningful there. Now, what could happen is that overwhelmingly those deferred taxes were probably entirely, even except there in the United States, were accrued at a 35% rate. So if the corporate rate changed, then you would have a major change in the deferred tax item, and there's always a possibility of that.
There would be a book entry. It wouldn't mean much.
It wouldn't mean much. Yeah. We do the float from the insurance business. We regard as a terrific asset. The deferred tax liability is a plus, but it's not a big asset.
What's the proper way to think about goodwill and return on capital? Berkshire's manufacturing, service, and retail businesses earn pre-tax returns on tangible capital over 20%, which suggests either skilled managers or fantastic businesses. But the return on allocated equity is in the single digits, which looks drab. Accountants treat intangibles similarly because they have different economics. For an indestructible brand like See's or Coca-Cola, I can see why the intangibles should not be amortized because it's worth more every year. And your comments on Geico policyholders were one way to think about that. But all the tobacco companies have billions of dollars of goodwill, and unit sales of cigarettes decline every year in developed countries. So perhaps they should be amortized. And for Time Warner, AOL, goodwill definitely needed to be amortized.
Yeah, goodwill, you mentioned AOL, Time Warner, something's right. It should be written off, actually. I mean, it wasn't, it was just a mistake in purchase price. The goodwill should not be used in evaluating the fundamental attractiveness of a business. There you should look at return on tangible assets, and even then there's some other adjustments you may want to make. But basically, in evaluating the businesses we own, in terms of what the management are doing and what the underlying economics of the business are, forget about goodwill. In terms of evaluating the job we're doing in allocating capital, you have to include goodwill because we paid for it. So if we buy, Coca-cola goes back to 1886 and John Pemberton at Jacobs Pharmacy in Atlanta, and there was not a whole lot of goodwill put on the books when he sold that first Coca-Cola. If you were to buy the company now, the whole company, you would be putting a figure, of $100 billion or something like that on it. You shouldn't amortize that. And you shouldn't, in judging the economics of the business, look at that. But in terms of judging the economics of the business that purchased it, we'll call it Berkshire, then you have to allow for the goodwill because we are allocating capital and paying a lot for it. I don't think the amortization of goodwill makes any sense. I think write-offs of it, when you find out you've made the wrong purchase and the business doesn't earn commensurate with the tangible assets employed and plus the goodwill, I think write-offs of it make sense. But when looking at businesses as to whether they're good businesses, mediocre businesses, poor businesses, look at the return on net tangible assets. Charlie?
Well, I think that's right. But as the gentleman says, when we buy a business, a whole business, we never get a huge bargain. And of course, we may get down toward 10% pre-tax earnings on what we pay. That isn't so awful as you think when a lot of the money comes from insurance float that costs you nothing. In other words, if you have $60 billion afloat and God gives you $6 billion a year of earnings, it's not all bad.
Well, on Lubrizol, we're paying close to $9 billion for the equity, and it earns. And you should make adjustments for debt, but it's not an important factor there. And current rate of earnings is probably $1 billion pre-tax. And now Lubrizol itself is employing they're employing, call it, $2.5 billion of equity to earn that $1 billion of pre-tax. So it's a very good business in terms of the assets that are employed, but when we end up paying the premium we pay to buy into it, it becomes $1 billion pre-tax on something close to $9 billion. You have to judge us based on close to a $9 billion investment. You have to judge James Hambrick in running the business based on the much lower capital that he has been employed. It can turn out to be a very good business, and we could turn out to have made at least a minor mistake if it isn't as good a business as we think it is now, but still is a very satisfactory business based on the tangible capital employed. Charlie, can you make that clearer?
Well, it's just we are not going to buy, in the climate we're in now, operating businesses that are all decent for low prices. It's just not going to happen.
I was wondering today if you could shed some light on accounting for goodwill. You reference in your report on several aspects, including your principles, owner principles, and as well as the fact with the current merger of General Re. It seems to me there are several different methods that are used worldwide, through amortization to direct write-off, and the fact when a merger like this is taken, it kind of skews the balance sheet. And I was wondering, in your view, what would you recommend as a more appropriate method for accounting for goodwill? And secondly, if I could direct it to Charlie, one of the ideas, why not tie goodwill to the share price and have an intangible and a tangible part of shareholders' equity, the intangible piece being the difference between the book value and the share value of a company?
Okay, I'll take the first part, and it's a good question about goodwill and the treatment of goodwill for accounting purposes. I actually wrote on that subject, I think it was in 1983 in the annual report, and if you click onto the BerkshireHathaway.com, you can look at the older letters, and you will see a discussion of what I think should be the way goodwill is handled. And then we've discussed it at various other times in the owner's manual. To give it to you briefly, in the UK, for example, goodwill is written off instantly, so it never appears in book value, and there's no subsequent charge for it. If I were setting the accounting rules, I would treat all acquisitions as purchases, which is what we've done virtually without exception at Berkshire. I would treat all acquisitions as purchases. I would set up the economic goodwill because we are paying for goodwill when we buy a General Re. I mean, we are paying billions and billions of dollars for it, or when we buy a Geico, or when we buy an executive jet. That is what we are buying as economic good, what I call economic goodwill. I believe it should stay on the balance sheet as reflective of the money you've laid out to buy it, but I don't think it should be amortized. I think in cases where it is permanently impaired and clear that it's lost its value, it should be charged off at that time. But generally speaking, in our own case, the economic goodwill that we now have far exceeds the amount that we put on the books originally, and therefore even by a greater amount exceeds the amount that remains on the books after amortization. I do not think an amortization charge is appropriate at Berkshire for the goodwill that we have attached to our businesses. Most of those businesses have increased their economic goodwill, in some cases by dramatic amounts, since we've purchased them. But I think the cost ought to be on the balance sheet. It shows what we paid for them. I think it should be recorded there. I don't think that the coming change in accounting is likely to be along the lines that I've suggested here, but I do think it's the most rational way to approach the problem. And I think that because there is this great difference between purchase and pooling accounting, that some really stupid things are done in the corporate world. And I have talked to managers who deplored the fact that they were using their stock in a deal and going through some various maneuvers to get pooling accounting because they thought it was economically a dumb thing to do, but they did it rather than record amortization charges that would result from purchase accounting. And they're very frank about that in private. They don't say as much about it in public. Charlie?
Yeah, generally speaking, I think that what Warren argues for would be the best system. Namely, set up the goodwill as an asset and don't amortize it in the ordinary case. However, there would be plenty of cases when the cases wouldn't be ordinary cases, when amortization would be rational, in fact should be required. So I don't think there is any one easy answer to this one. And there's a lot of crazy distortion in corporate practice because of all the changes. I mean, Australia has cowboy accounting, and Europe has this write it all off immediately accounting, which is, what would you call it, half cowboy accounting, and maybe mining promoter accounting. We think the system should be better than that.
My question is your comments on the new standards for the accounting of goodwill.
Yeah, the question about the new standards for goodwill, actually, if you read, I think, the annual report, maybe the 2000 annual report, and maybe even earlier, but we prescribed, we said what we thought would be the preferable system for how goodwill was handled, namely that it would not be amortized and that combinations of companies be accounted for as purchases. And it pretty well is what ended up coming out of the accounting profession. So the goodwill rules now are in accord with what we believe they should be. And for a long time they weren't. you might argue that it was against our interest to have what we think proper accounting is put in, because some people were averse to buying businesses because of a goodwill charge they would incur, whereas it made no difference to us whatsoever. We just looked at the underlying economics. So we may have a little more competition even on buying businesses, simply because now competitive buyers are not faced with a goodwill charge, which may have bothered them but didn't bother us. I regard the present goodwill rules as making sense. Charlie?
Well, I agree.
Okay.
Thank you.
Could you comment on Gen Re and goodwill impairment charges since you purchased it, and how it's evolved in your thinking, and if it even became a part of your thinking?
Sure. The question relates to the fact that if you buy a business at a price over tangible assets, that you set up a goodwill account, and if at any time in the future that goodwill becomes impaired, you should and must, if the accounting is proper, run a charge to reduce that goodwill item. You run a charge through the income account. We have a large goodwill item for Gen Re because it was the biggest acquisition we ever made. We paid substantially more than book, and the question is whether that goodwill is impaired. And certainly if the operations of Gen Re of the last couple of years, not including this year, but of the years 98 through 2001 more or less, were representative of the future, you would say that there has to be a big goodwill charge there, and I would agree with you. I think that as Gen Re is operating now and had the capacity to operate, and it's being realized now, thanks to a couple of great managers we've got there, I think that I personally think that Gen Re is worth more now today than at the time we bought it, and I think its float has increased substantially, and I think that you will see the float turn out to be cost-free over time. One thing I should have mentioned actually is, and I looked at a draft of our 10Q. I think we should put this in there. Gen Re up until this year was discounting workers' comp reserves at 4.5%, which was not conservative. That we inherited that situation, but we have changed that to discounting comp reserves going forward at 1%. So the accounting is more conservative going forward now, 2003, by a fair margin than it was in prior years and in a method we inherited. So that the figures you see would be somewhat better if we had continued the old discounting at 4.5 rather than go with the new discount rate. And in the draft I saw the 10Q, that wasn't in there. I think we should get that in there, Mark, while I think of this.
Related question in banking. Are banks too focused on goodwill amortization when declining to buy other banks for cash, thereby using purchase accounting versus the normal practice in the industry of pooling accounting, even when the stock that they issue may be depressed or undervalued?
Your second question about goodwill amortization and purchase accounting versus pooling, we care not. At Berkshire, it absolutely makes no difference to us what accounting treatment we get on something. We are interested in the economics of a transaction. Some banks, some businesses generally, most businesses perhaps, prefer pooling because they don't like to take a goodwill amortization charge. We think our shareholders are smart enough, particularly if we make it clear to them the accounting consequences. We think they're smart enough to look through to the economic reality of what Berkshire's businesses are all about. And I think that some managements sell short their own ownership group by doing various kinds of financial acrobatics in order to have the charges come in a certain way rather than, as you point out, often they might be better off buying for cash rather than their own stock as currency, but they may prefer to use their own stock because they avoid goodwill charges. We've written a few things on goodwill in the past, in past annual reports that might get to that subject. We don't care what accounting. We sort of rewrite the accounting for any business that we're looking at, because in our heads we want to have in effect, a standardized way of looking at businesses. And if one company goes through pooling transactions and another goes through purchase transactions, we're going to recast them in our own mind so that there's comparability. Charlie?
Yeah, the published accounting results are in accordance with standard convention, and they're a place to start economic analysis. The figures are frequently quite silly on a functional basis. I'm not criticizing accounting conventions except for some.
Yeah.
But I think it's just a place to start thinking about economic reality. By their nature, they can't tie perfectly. They can't even tie very well to economic reality.
We regard it as a negative when we find a management that's preoccupied with accounting considerations, but we find it so frequent that we can't afford to use it as a total exclusionary factor. It really surprises me how many managements focus on accounting and the time they spend on it. It's really unproductive. If you find a management that doesn't care about the accounting but does explain to you in clear terms what's going on, I think you should regard that as a plus in owning a security.
Some companies, I don't know, then we'll get on with this, but some companies care about the consideration they give in a deal, whether it's cash or preferred or so on, because they care about the accounting treatment that they get. They usually want pooling treatment rather than purchase accounting treatment. I won't get into that here. I know it's going to disappoint you, but I won't get into that here, although I may in the next annual report. And that is of absolutely no consequence to us. We care not a whit about the accounting treatment that we receive. We feel that we have a shareholder body that's intelligent enough to understand the economic reality of a transaction, and that by playing various games in terms of how we try to structure it and maybe flow part of the purchase price back through the income statement or anything of the sort, which is done, that's not something that we care about at all. We would rather do whatever makes the most sense for us and for the seller, and then explain to you whatever accounting peculiarities may arise out of the transaction. And that probably differentiates us from most companies, and it probably helps us make a deal occasionally.
With all due respect to Mr. Eisner, if he's in the audience, there's been some criticism levied recently at the Disney company, mainly from an accounting professor at one of the state universities in New York, in reference to Disney's purchase of Capital Cities and the way they accounted for that purchase. Basically, what this professor is saying is that Disney somehow created a slush fund and is charging the expenses to the merger to this slush fund rather than earnings. If you're familiar with this criticism, I'm wondering what you think of it. If you're not, are you familiar with the way Disney accounted for the purchase of Capital Cities?
Yeah, I am familiar.
Thank you.
And actually, Abe Brilloff, who wrote that, is a fellow who in general I admire. Abe wrote me a letter not more than about 3 or 4 weeks ago and asked me to talk at a university where he teaches, and I wrote him back, and I told him I wouldn't be able to do it because it's not in proximity to where I'll be. And I told him, and he asked me about the Disney thing, and I told him I disagreed with him on certain. I admire what Abe does in the attempt to have accounting reflect economic reality, but he and I don't see it exactly the same on some points, although we would agree on other points. I don't think Disney is a very complicated enterprise to evaluate. I mean, when Cap Cities bought ABC, there were purchase accounting adjustments, and they tend to wash through to some extent. I mean, if you have programs that you're stuck on, you may write those down from what the previous carrying cost was. Maybe the previous management should have written them down too at that point. But I don't think that. I think with Disney, what you see now is what you get. Charlie?
Yeah. I've got no great quarrel with the accounting at Disney. I think Brilloff is a wonderful guy. He's got a good sense of humor, and he generally fights the right demons, but I don't think you can criticize Disney's accounting.
We certainly disagree with Abe, who, like I say, I agree with Charlie. He's a good guy, but we disagree with him on amortization of intangibles entirely. So we would say that if Disney is charging whatever it may be, probably $400 million a year for amortization of intangibles, which is not tax deductible, we would include that as a component of earnings. So there might be some pluses and minuses that you would make in adjustments, but I would say by the time you had back amortization of intangibles, that we would probably think the economic earnings of Disney might well be more than the reported earnings in the next few years. I think that the intangible amortization question, which the FASB is looking at now, I think it should be changed. I mean, I think it absolutely distorts economic reality, and I think that it influences whether people go to purchase or accounting or pooling, and they do all kinds of acrobatics to try and get pooling accounting. And it shouldn't make that kind of difference in reported numbers based on whether a transaction which has exactly the same economics is done through a purchaser pooling. But I have seen managements, some I know quite well, arrange to do things on a pooling basis that they think if they were private, they would do it on a purchase basis. And I think that's nuts. And I think if accounting is pushing people to doing things that are nuts, that it's time for accounting to look at itself. I would say that net, the economic earnings of Disney, in our view, are somewhat higher than reported earnings.
There's one other footnote to these figures that I should point out. It's already been picked up by the wires from our 7 o'clock filing. We report on Kraft Heinz, of which we own about 27% or so. We report on what they call the equity method. Now, most stocks, when you get dividends, that goes into our earnings account, and their undistributed earnings don't affect us. They affect us in a real way, but they don't affect us in an accounting way. We are part of a control group at Kraft Heinz, so instead of reporting dividends, we report what they call equity earnings. Kraft Heinz has not filed their 10K for the 2018 year with the SEC, and therefore they have not released the first quarter of 2019 earnings. Now, normally we would include our percentage share of those earnings, and we've done that every quarter up till this quarter. But because we do not have those figures, we've not included anything. We received 40 cents times $130 million of dividends in the first quarter from our shares, but that reduces our carrying basis, and it is not reflected in the earnings. So that's an unusual item which we have mentioned, specifically pointed out in our press release as well as included in our own. But there is nothing in here, plus or minus, for Kraft Heinz earnings this year, whereas there was last year. And when we have the figures, obviously, we will report them.